And good afternoon, financial professionals. I'm John Florence, and I am your host today at the BREW. I welcome you today to the program where we build relationships every week. Thanks for tuning in today. And if you're joining us for the first time, we usually like to start the BREWcast by celebrating today's national days. Today is National Receptionist Day. So make sure that you greet those people at the front of your offices and office buildings and any place that you go on. Usually an underappreciated job for the quality client work that they do, and just make sure you say thank you to them. And then today is also National Eat What You Want Day. And I celebrated already by having white toast with Concord grape jam this morning, something I don't usually eat, but I just really felt like it today. So eat whatever you want. Don't feel guilty about it. Go back to your regular program of eating tomorrow when it's no longer National Eat What You Want Day. Today on the BREW, we are joined by Daniel Davies. Daniel Davies is the Regional Vice President of Private Placement Solutions with Prudential. And he is going to be discussing ultra-high net worth individuals and the use of private placement life insurance with those kinds of clients. So feel free to use the chat box to share any thoughts or questions that you might have. Also, all attendees are in a drawing today for a prize, and we'll be announcing that winner at the end of the program. Thanks for tuning in, and for now, I will hand the mic over to Dan Davies. Dan, welcome to the BREW. The floor is yours.
Thank you, John. Thanks for having me today and allowing us here at Prudential to share our private placement solution and where it can fit in the market. So, this is a niche solution for the ultra high net worth. It's been around for 20 plus years. And I'll do a quick overview of where it could come to play in your practice and talk about the value proposition for high-end clients who, private placement is really about tax efficiency of investments using insurance, an insurance product. So again, here's what we'll walk through real quick. Impacts of taxes historically, what the PPLI solution looks like, and let's identify some client opportunities and where PREW is in this space. So if you think about the tax environment, and let's just give this a second to come up. Even today, we look at 2012 to 2020, the change. And even if we look at this from ordinary income, capital gains, dividends, we've seen tremendous increases. After the political party changes in 2020, everyone anticipated additional increases that didn't necessarily occur. But I think the momentum relative to the debt, relative to the environment of raising taxes for ultra high net worth clients is moving in that direction. And a byproduct of that is we need solutions to continue to provide efficiencies for these clients. The trend is there, the opportunity is there. And so let's take a quick look. The effects of taxation are huge. It's not about what the gross return is, it's about what the client is taking home. So if we look at a gross investment return of 8%, and you aggregate federal tax, state tax, etc., and a client who does not have good tax planning, you're going to look at a net return back of about 50% of that 8% or 4% return. And again, this situation I think we have here is for a California resident. PPLI is all about using insurance structure to get that 8% gross, make the net as close to that 8% gross. And so how does that work? Okay, so PPLI essentially is a variable universal life chassis. We've reduced a lot of the fees and costs with traditional structure insurance. And so what we drive then is the cash value of the solution. And through that, we're able to provide costs that are very institutionally oriented, very minimal costs on the PPLI. So a client who would be getting a gross of 8% in the PPLI, we can get the cost of the whole insurance product and fees associated with it to be less than 100 basis points. In this case, 80 basis points. So the client is returning 7.2% in the structure. So how does this compare? Well, the comparison is pretty obvious. You have a net of 4% in a brokerage account on a highly taxed individual, or you have a net return closer to that 8%, the 7.2. So the solution really is just trading off taxes for the cost of the structure of the insurance. And if the numbers are favorable, of which they are in most cases for these types of clients, then the math will tell the whole story. Now that's part one of the story. Part two is this is a long-term solution. So again, it isn't something that a client is going to do for 5 or 10 years. This chart really shows what's happening here. You have a client that's going to put in $5 million over 4 years. And this shows the cash surrender value in a brokerage account net of taxes and the cash surrender value in a PPLI product over the life of the contract. And you can see the value prop at year 15 and year 20 is pretty substantial, where you have a PPVUL advantage of over $5 million on this $5 million original investment. And this is really what the solution is all about. So let's talk about the components of the PPLI solution. Again, it's a variable product. It is, and I'm starting right at the top middle here, variable product written by a variable licensed insurance producer. You have the manufacturer, the Prudential solution, the PPLI for us. We have a very high capacity. We have the optimal underwriting, and I will get into it in a minute, but at the bottom middle there, we have the inventory of investment options. And so the solution is really as good as the investment options for the clients. The two, well, I'll focus on here, insurance dedicated funds, IDFs, and then MSA is the acronym for managed separate account. So essentially the IDFs are investment alternative funds that have been brought to PREW over the past 20 years. And they represent hedge funds, private equity, private credit, a whole variety of strategies that complement an ultra high net worth client's portfolio. The managed separate account is a more customized solution where a client can work with a variable licensed insurance broker, and through a discretionary account, we can assess if the client's RIA can be involved in managing a particular strategy for the client. So a more bespoke solution. And then obviously, if you finish off the quadrants here, we have the policyholder, the client owner, which must be a qualified purchaser, accredited investor. That being said, the market for this is really clients with a net worth of greater than $25 million. So general process here, we have the qualified purchaser, accredited investor, policy owner, working with a variable licensed agent, Prudential, the manufacturer. We may rely on reinsurers to get the coverage. Again, this is underwritten similarly than traditional insurance. Because of the premium amounts, we often have to go out and partner with our reinsurers. That being said, we do have a $65 million auto bind. So if the funding parameters of the PPLI are at $65 million or less in face amount, we can underwrite that directly here at PREW. Then the dollars are essentially housed in a segregated account, of which the investment options I outlined earlier. So most of the designs we see are pretty familiar to what agents see out there in the field, where if you're doing a cash value oriented insurance product design, we're going to follow the same MEC and non-MEC rules that are done on regular products, variable and index products. So you'll have a higher death benefit at the start. You'll reduce that death benefit. The reduction will reduce COIs, and the whole idea here is reduce the cost of the insurance structure, the insurance contract, to drive cash surrender values, because the focus here is on driving the values of the investment in the insurance chassis. So again, nothing new here from the insurance world. We're just taking advantage of the IRS regs around 7702. The tax-free growth within the insurance product is assuming a non-MEC design, tax-free passing of the death benefit, flexible access to the cash into the account, so favorable loan or withdrawal situation for the contract, no surrender charges. Again, everything's transparent in the cost structure. This is a difference. So if your client is putting $5 million of premium into this, it's very easy to see the flow of where all those dollars go, how much is going into the cost of the structure, how much is going into the investment. An attribute of the PPLI is elimination of K-1s for the client. And again, I talked briefly about the access to robust or varied investment options. So again, this is a great comparison of the brokerage account on one side and the PPLI solution. Again, eliminating investment income taxes, eliminate capital gains, no taxes on dividends. We got the estate tax exemption, we got exempt K-1, and so forth. Related, again, the comparison here is about the inefficiencies of certain investments in the brokerage account. Now, one thing you'll notice is I'm making the reference to brokerage account versus the insurance products in life insurance death benefit. While this does have an insurance death benefit, the focus again here is on the buildup of the cash value. So if a level type of death benefit is a priority for the client, I would recommend sticking with traditional insurance products, which are focused more on the insurance aspect versus the cash value aspect. Okay. And again, so what we see here with clients, obviously, is any clients that have a sensitivity or have high tax liabilities, have interest in alternative investments, looking to diversify a large portfolio with some of those types of investments. Clients with liquidity events, again, pre-funded trusts. The one bullet here that we are, I put it as a low priority is supplemental retirement income. Most of the clients going into PPLI now really do not look at this as a distribution or a retirement supplement. These are dollars that they really don't anticipate needing in terms of any type of income in the future. They might want some type of lump sum distribution to make a purchase in the future, but they really don't have income needs in the future that they need to drive out of this type of product. We will do 1035s from existing products in the PPLI. We'll do term conversions of Prudential products. And I think the last thing there is this is used as a, well, I'll say alternative to traditional retail life. PPLI is often a complement to existing traditional sales. So we don't see it replace it. What we do is we see it complement it. So we see a lot of sales, a lot of solutions where a client is purchasing traditional coverage and then supplementing that with a PPLI policy as well. So it's actually taking out two different policies. Again, so where are these clients? Well, pretty evident, family offices, large RIA firms, and any advisory service firms for ultra high net worth clients. I would say the newest area where we're identifying partners in this space are with brokers who have relationships with AUMs with more than $1 billion in assets under management. The separate managed account solution is favorable to RIAs now because RIAs can charge their fees within the product and manage a custom portfolio in a discretionary account that is really just moving or providing a tax-free strategy after the PPLI sheltering aspect. So the RIAs have a real complement to add this solution and retain the capital within their AUM, which has really helped enhance the partnerships with brokers who are working with these RIAs. And again, I'll finish up here with Prudential. So again, Prudential, we have a retention of 10 million. The big numbers here really are the 65 million auto bind. Facultative capacity right now, I think we're at about 110 million. But really, we want to make the underwriting as transparent, but as efficient as possible, because the focus again is on the driving of the underlying investments in the structure. That being said, here's some of the parameters that we look at. If clients are looking at an insurance dedicated fund, we're looking at a minimum of $1 million in premium. If they're looking at an RIA to partner with the client and a variable licensed broker, we're looking at a minimum of $5 million of premium into the solution. And I won't go into all the details here, but it's available in 48 states, but most of the PPLI is written through 3 or 4 states that have favorable premium tax rates that reduce the cost of the insurance structure. Those states are Delaware, Alaska, South Dakota, and Wyoming. Again, PREW in the space, 20 plus years, one of the most competitive products and solutions out there, and investment options, whether it's insurance dedicated funds or partnering with RIAs and other centers of influence that brokerage firms will have. And with that, I will turn it over back to John and see if we have any questions that I can address, and I appreciate your time.
Dan, thank you so much for that great share. Really fascinating information. I would remind all of our viewers that the chat box is open if you have any questions. I will start with one, just a simple one. This is a solution, Dan, if I'm not mistaken, that's been around for a number of years. But my feeling is, and correct me if I'm wrong, that we're seeing a lot more interest in it recently. What is driving that change, or what, you know, if it is in fact a change, what's causing people to be more interested in this type of thing in this environment?
Yeah, I would say that would focus on 2 things. One is, you know, the general momentum in tax environment of increasing taxes for the ultra high net worth. Part of that obviously is political. Part of that is you know, financial, related to the debt of the government and where are they going to raise capital for you know, future expenditures, you might say. So that's part one. Part two is the solution has really added a lot of additional investment options and flexibility the last several years. So additional what we call insurance dedicated funds that are a lot more broad and more awareness in this market. And 2, the partnership and solution of what we call the managed separate account. So an RIA can participate with a broker and not have to send the premiums for the PPLI out to a different manager per se, but can control the portfolio and retain the dollars within their AUM at the same time providing the benefits to the client. Those are the two biggest changes that have driven the attention in the space and the growth in the space.
Very interesting. One of the questions in from the audience is related to compensation. You said a big area of growth in this solution space has been with registered investment advisors and people who are probably not working on a commission model. But for those advisors who are still part of a traditional broker-dealer structure or who work on commission, how does compensation work on something cases these sizes?
Yeah. So on that, I'll work backwards on that. So from the investment manager standpoint, nothing really has changed there. If the money goes into an IDF, the manager of that insurance dedicated fund is going to charge their investment fees. If the RIA is managing the portfolio, the RIA will charge their management fees. Typically, we're seeing them charge the same thing they do in a brokerage account. So no changes there. On the variable licensed broker on the case, what we'll see that's very customizable case by case, but I'll say what we see is a range from 50 to 150 basis points of what we call a placement fee or premium-based compensation on the front end of all new premium payments is part one. And then part two, which is really more compelling, is a trail on the cash surrender value of the policy. And that will range, again, I would say anywhere from 25 to 60 basis points. And again, that trail will pay in perpetuity as long as the policy is in force accordingly. So again, compensation structure that is a long-term, and it's a nice complement to the traditional HEAP structure.
Absolutely. Very interesting. Understanding that these are custom cases in every single situation, that the policy and the underlying management, et cetera, are custom designed. I imagine the lead time for putting together a case like this is maybe longer than what a person might normally expect. Can you talk a little bit about that? What's the window from somebody initiating something like this to the point where you actually typically see something come to fruition?
Good question. Similar to a large, a $10 to $50 million traditional insurance case, anywhere we look at anywhere from 6 to 12 months window on the PPLI. What has been, I don't want to say unique, but a little bit of a change is we've seen a lot more complementary activity where a traditional sale is made and a PPLI sale has been made together. So an insurance death benefit focus has been handled for estate planning purposes. And as the discussion with the clients move forward, the tax efficiency of PPLI comes into the conversation with the financial advisor, attorney, CPA, et cetera. And we've seen a lot more of those opportunities too. But the underwriting process is the same. We'll tend to see an informal on these cases. While the underwriting is being done, some of the planning behind the scenes, the illustrations, the design of premium funding will take place. So 6 to 12 months is pretty consistent in what we have. We've had a few shorter. We have had some quite a bit longer too.
Fascinating. This has been a very enlightening conversation. Dan, it looks like I don't see any other questions right now in the chat box. So I want to thank you again for your contribution to the BREW today and for sharing your knowledge and expertise and background with our listeners today. So we move to the part of our program where we do our giveaway. And Dan, I'd like to ask you to pick a number between 1 and 20.
How about 17 today?
17 is the number. Let me see. Our winner today is Jose Ramirez. So Jose, congratulations. Be on the lookout for a complimentary CE voucher and a Starbucks gift card coming your way from all of us here at E4 Insurance Services. Once again, Daniel, thank you so much for your time today. Ladies and gentlemen, that concludes our presentation. Tune in next week. I yours truly will be here discussing sales idea related to non-qualified annuities and long-term care planning that may be suitable for you and your clients. So stay tuned. Welcome again, and we'll see you next week on The Brew.
Thanks, John. Bye.